And we'll be looking at gold's reaction to the ECB this morning. We have Jim Wyckoff joining us now. Jim, good to see you.
Hello, Daniela. Always nice to be with you.
Thanks, Jim. So the ECB announced this morning that it plans to wait until 2015 to decide whether or not to expand its QE measures. Any surprises here, Jim?
Well, Daniela, not really. I think the marketplace in general expected no announcement at today's monthly ECB meeting. And in fact, they were expecting something coming in early 2015. The marketplace and gold initially read Draghi's press conference remarks as being a bit dovish, and that popped gold for a short period of time, but then prices fell back to where they were trading before the Draghi press conference. Draghi apparently did make mention of not using gold as part of his quantitative easing program. That was reported to maybe pressure gold a little bit, but I think the vast majority of the marketplace did not expect gold to be a part of any QE equation in the first place.
Jim, any clues as to why you think Draghi would wait until 2015?
You know, Daniela, that's a good question. I don't know why. They've gotten, the European Union has seen a string of downbeat economic data, and maybe the ECB just wants to wait till the new year to take some action.
And on the news, Jim, we saw the euro currency rally, whereas the US dollar index sold off, which was bullish for gold. Jim, the next big news item we have this week is job numbers tomorrow.
Yeah, Daniela, the non-farm payrolls number is seen coming in at up around 230,000 in November. Any figure that deviates above or below by a significant amount is probably going to move the markets. So we'll just have to see how that plays out.
So as we're closing off the year here, we are seeing so much volatility in the gold market. What is one to do? How do you position yourself, Jim? I know it's different for an investor versus a trader, but how do you position yourself?
Well, Daniela, as I mentioned in my report a couple of days ago, this volatility on an intraday basis is bad for the bulls and bears. The thing that I do find important about this week's price action in both gold and silver, that huge move we saw in prices on Monday with a close near the daily high in both gold and silver does suggest that the bears have become exhausted at lower price levels and begins to suggest that we are at near-term lows for both gold and silver markets. Now, to better suggest such being the case, we need to see some follow-through price action yet this week. Bullish weekly high closes or close to it on Friday would be an indication that a better indication that these markets have put in near-term lows. But this higher volatility we're seeing at lower price levels is an early hint that the bears are exhausted and that we might be close to market lows.
All right, Jim, on that note, let's get to your Wyckoff market reading for gold and silver this week.
Daniela, I'm giving February COMEX gold and March COMEX silver both a Wyckoff's market rating of 3. That's up from last week, but still in the bearish camp. The bulls have more work ahead of them to suggest that prices can sustain a near-term uptrend. For February gold, I'm seeing solid technical support at 1184 and change, solid overhead resistance at this week's high of 1221. Looking at March COMEX silver, we've got solid technical support at $16 an ounce, solid overhead resistance at $17 an ounce.
Thanks so much, Jim. We'll see you next week.
Always nice to see you, Daniela, and take care. Bye-bye.
And thanks for watching this edition of Technically Speaking with Jim Wyckoff. We'll see you Friday.